You're about to join Jerry Parker, Moritz Siebert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Moritz, Siebert and I, Niels Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing, and of course where we also take some of your questions. But today we're going to deviate a bit from our usual format because we are delighted to be joined by a very special guest, Mark Rzepczynski, and I probably got that not quite perfect, Mark, but you'll correct me, from Amphi Research and Trading. True legend in our industry, and I'm sure a lot of you are already familiar with Mark and his blog. So let me start by saying welcome to you, Mark, and it's great to have you here, and of course also good to have you, Moritz.
Thank you. Really happy to be here.
Hey, Niels. Hey, Mark. It's been a long time in the making. Very glad to have you on.
Absolutely. Yeah. Now, we are, of course, very much look forward to diving into a lot of topics with you, and not least because you've been in the trenches for a few decades. But we normally do kind of a quick review of the past week from the lens of a trend follower. And so while you may want to have an extra sip of your coffee while we do that, we'll quickly go through some of the highlights. It shouldn't take too long. So, Moritz, just as a quick market wrap from my side, I mean, despite the equity markets finishing the week on a down note, you can't really argue that if you look at the price level in isolation, you think the economy is doing great. That's kind of the story the equity markets are telling. But then bonds are telling quite a different story, because I noticed that Friday morning, the 5-year Treasury yield sank to an all-time low of just 0.255%, hardly above the Fed's overnight funds rate, which is somewhere between 0 and 0.25. And then the nominal 10-year yield is touching 58 basis points, which is pretty close to the all-time low of 49 bips in March, I think it was. And then the real yield, so the nominal yield less the 10-year Treasury inflation-protected securities, has fallen to negative 92 basis points. That's actually the lowest level on record going back to 1996. And then, of course, combine all of this, we have gold closing in on a new all-time high. So two different stories. We don't know really who is going to be proven right. Normally they say that the smart money is the bond market, but who knows? This time might be different. But how was your week, Moritz?
A down week, but an interesting week nevertheless, even though, like you probably suggest, not too much movement compared to the weeks before. When I looked at the equity markets, I think the S&P probably made a high on Wednesday, and then had 2 down days, probably finished the week a little lower. I didn't look at the numbers, but it felt like it. So not too much to see there, but in terms of the bond market, because you've just mentioned that, yes, yields are moving lower. They're moving lower across the board. There's been another central bank lowering rates this week. Not that I don't know, I don't want to say we don't care, but it's been Russia. I think Russia is now at 4.25. So this is massively high compared to the ECB and the Fed, but 25 bips down for Russia. We have long-term mortgage rates at the lowest ever in the US, I think, but definitely also in Germany. So if people wanted to buy a house and have that financed, I don't want to say this is a good time to do it. Maybe in a couple of weeks, the rate's going to be even less. Who knows? But it's a new all-time low. So in terms of the portfolio, lost about 0.5%. I'm down for the year about 3.5% or something like that. There's really only been 2 winning positions that I had on, significant winning positions, and all the other stuff has just been noise and essentially been flat, and that's been gold and silver. So not surprisingly, and especially silver, because, silver has just shot to the upside, massive breakout, trading north of 22. Yes, it's the very volatile cousin of the gold market, as some people say. Not sure that is true, but when you look at the chart, I mean, those silver moves, as we know, it's always kind of been like that. They're volatile in both directions, to the downside and to the upside. This time to the upside. Luckily, I've had a long position on. I guess probably most of the trend following funds would have had a long position on, and we enjoyed that. But like I say, the other markets kind of boring.
Yeah. I mean, very quiet week for us as well. Very similar performance on our side as to what you mentioned, which, by the way, we may come to a little bit later, because it seems like both you and and we are underperforming our peers this year so far, at least when I look at the industry, but we'll get to that maybe. But on our side, really coffee, yen, NASDAQ were the main losing markets. Gold, corn, US 30-year bonds were the best markets. And we did actually see some meaningful movement in the markets this week. It just happens that a lot of these moves were kind of offsetting each other. So net, not a lot happened. And as I've mentioned before the last few weeks, I mean, our overall portfolio risk is incredibly low, probably the lowest that I've seen. Not the lowest we've seen if we go back and we look at kind of research data, but it's really low, about 25% of our maximum. So we're certainly not identifying any, or not a lot of long-term trends to get ourselves excited about. That was a quick market wrap. So Mark, perhaps I want to do something a little bit different with you today, because I do think you have a fantastic story background, and maybe not everyone that listens to our podcast today are familiar with you. So I would actually love to hear a little bit about your journey to where you are today. Of course, I'm particularly interested in about your decade that you spent with John Henry, or I should say John W. Henry, as president of the firm, which of course is a legendary CTA firm. So yeah, why don't you tell us a little bit about your way to where you are today, and then we'll dive into some exciting topics.
Sure. I think let's start with, how did I get involved in futures markets? And I grew up in Chicago, and I had an opportunity to work down at the Board of Trade. And I don't know the first time you went to the visitors gallery at the Board of Trade. You take the escalator up, you look across the pits, you see complete chaos. You see all these people yelling, screaming, colors all over the place, boards showing prices moving. And I think that people just have two reactions. Either they're revolted by this and said, let me turn around and get out of here, because this is no way for anybody it should work. The alternative is that I don't know what's going on here, but I want to find out more. And I probably sort of say that has been my driving theme across my career, is to say, how do people make tough investment decisions in a complex world? And we could talk about this a little bit more later, but I think that we'll sort of say the path that I've always taken is to say, like, how can you be a better decision maker when you have a lot of uncertainty, when markets are constantly changing, information is changing, flows are changing? What do you have to do? So that took me on to graduate school. I received my PhD in economics, was a professor for a number of years, came back, worked for the Mercantile Exchange right around the 87 crash. Then, worked for a number of money management firms. I was the head of research at Fidelity for the fixed income bond area, very large traditional money manager. And then from there, I worked with John Henry, which I think that it was a path, again, to sort of say, how do you deal with uncertainty? Because I'll say working with a large institutional money manager, what you're really focused in on is that you go into a morning meeting, you have a committee meeting, everyone gives their opinion, and somehow there comes a conclusion from all of this committee work. And I didn't really find that very satisfying. I think that there are better ways to make decisions other than the weight of discussion or debate in a committee. So the better debater wins the day, as opposed to what may the evidence show. So having an opportunity to work with John Henry was just great way to be able to solidify my thinking, great way to apply quantitative tools. And I think we did a pretty good job of being able to raise assets, tell a story, and continue on the great business he had. Now, I think that one thing I could say about John Henry is that he did a fantastic job in the markets, and he had other passions. And so I think that it's great for someone to be able to try other things in their life. And I think that his passion for baseball, his passion for sports, led him in a different direction. And so we parted ways. I ran a global macro hedge fund using a lot of the principles that I developed in the past. Then ran a commodity fund to funds for a number of years. Now I think I'm slowing down a little bit. And so I have an advisory business where we advise pensions, other hedge funds, as well as asset managers on how to employ quantitative strategies and use different principles for better decision making. So we've come full circle in sense of running money to also now advising people on how to make better decisions. So we're still in the working on the same theme, I would sort of start 30 plus years ago.
Yeah, no, I mean, it is a fascinating story. And of course, the John Henry really was a legend in our industry. But what's really fascinating about him as well is that he's gone on to have exactly the same level of success in two other businesses, both in baseball and now in European soccer, with Liverpool crown champion for the first time in 30 years. It's quite extraordinary. And in a sense, it would be really interesting to figure out whether the secret to his success in the trend following world really has been or played a key role in the success that he's built in sports. I don't know if you know anything about.
Well, I followed it pretty closely, and I was in the room when they closed a transaction for the Boston Red Sox. But I can give you the secret for John Henry's success across a number of businesses.
Sure.
Okay, the secret is he's just tremendously focused. I've never seen someone as laser-like focused at the moment. He probably said more focused than any other individual at a given moment. So when he was looking at a table or a chart of numbers when we were discussing our trend following positions, is that he could look at a pages and pages number. He could find the one wrong number. And I think that for baseball, for Liverpool soccer, is that his has a tremendous focus for details. And I think a lot of your listeners will say, like, gee, that's the secret. That's just so hard to do. But in reality, I think that he was able to accomplish that. Now, there's no question he's a very smart man, but I think that smarts is not enough to be successful. It's the focus that really differentiates you from others. And I think that that's what really is separated him or put him apart from others.
Yeah, I think actually there's a book written called Either Focus on This or Whatever, which also became very popular. And there's no doubt that focus is incredibly important. I wanted to just jump off in terms of one question before Moritz has quite a few questions as well. But you mentioned something in your introduction, which I think is this thing about, your curiosity about how humans are able to make tough decisions in an uncertain world. Because if you think of the DNA of a person, of the humans, how we are built. I mean, we're built for kind of instant gratifications. We have no patience. We don't like uncertainty. I mean, there are many things you can line up. And then you think about financial markets and being an investor, and it's kind of complete opposite. You need patience. You need to be able to deal with uncertainty. So where is that kind of curiosity? Where has that led you in terms of how we deal with this? We of course know as an industry how we deal with it. We rules-based things, we systematize things, but just I'd love to hear your thoughts on that.
And I think that that's where I've come out is that if there's a spectrum between, you could say that I'm a complete discretionary person. I use my wits to make my decisions, try to take in all information, and my skill and experience will come together to form a better decision. Say that that's one extreme. The other extreme is to say, well, let's just say I'm always going to be governed by a set of rules. Now, I would probably sort of say that after all the experience I've had, sort of focusing in on rules will always help you more than leaving yourself to discretion. So I think that, and if you go back down to the example, when you go down to the floor of the Board of Trade when it was open, or the Mercantile Exchange, the people who were most successful were those who probably were very disciplined and structured and rules-based. So there is a level for expertise and practical knowledge. But I think in general is that if you sort of first work under the premise that I should have a set of rules or framework for making my decision, a checklist, you will be better off than if you sort of say, I'm just going to use my wits.
What's on your mind, Moritz?
Focus is on my mind. I found that really interesting, like the ingredient for success. And I was just, when you two guys chatted, I was thinking about it, and I can certainly think about a number of activities where focus is incredibly important. Think about a game of tennis, right? It's 1.5 hours or 2 hours. If you're not focused on the game, you're going to lose the game. You've just mentioned the options trading pit. It's during the floor session. If you're not focused on that business, you're likely to make mistakes and lose money, right? If you're having a very important negotiation like the one you alluded to with John W. Henry acquiring a baseball team, probably very, very important to be laser focused during that point in time and get that negotiation right. But now to my question, if you run a CTA, a systematic CTA, Niels and I are involved in that, you are involved in that, what's the value add of permanent focus? Because, at some point, the thing just runs. In my opinion, there's no need to be 12 hours super laser focused on the markets every day. That's not what we do. So
Sure.
To what extent do we need the focus for our business?
Well, there's a different, their focus is slightly different, or it's centered differently. And one type of focus I would say is mental toughness. I think that if you're a trend follower and you're following rules, you need mental toughness, because sometimes this is that you're going to see a signal that comes out and you say like, oh my God, I can't believe that I'm going to go short this market at this time. This makes no sense whatsoever. Every newspaper story I read is telling me I should be doing the opposite. And you have to have the mental toughness to say, I'm going to follow the rules. That's a form of focus. The other one, when you think about it, is that you think of great musicians. If you talk to them about how they become great, it's because when they practice as if they're in a concert, that they're completely focused to try to say, how do I get everything right? And from a trend follower's perspective, that is expressed through the research process. When you think about it, is that you could do some form of back testing, you test some models, and you look at different variations. But I think that what separates a lot of people, especially in trend followings and rules-based, is very focused on, what am I doing in my model? What am I adding? What are the implications of this? How do I back test this properly? So there's different forms of focus. And if you're a trend follower, I think the great part about it is that you don't have to be focused on every tick in the market, but you do have to be focused on, how do I look at it improving my model if I want to? How do I make sure that it's optimized in the senses that I'm getting the best execution for my trades? So the focus may be slightly different, but it requires a tremendous amount of focus and precision.
Yeah, I think it requires some, clarity, mental clearness, if you will. Like, when you engage on an evolutionary research process, you don't want to do that, tipsy-turvy. You want to be very structured and principled about how you do this. And that probably, requires experience, and then you need to focus on how to get it done. But like you say, there's no need to focus on every tick in the market. That just adds no value to the way that we trade.
Right.
But staying with John Henry, maybe just for a little bit before we actually kick off our questioning session, which I'm looking forward to, because there's been a real set of interesting ones today. But back to John W. Henry, maybe just for our listeners and maybe also ourselves, how did the day-to-day business of John W. Henry run? I mean, there were no cloud servers back then, right? Today
Right.
they're there. Python code runs automated, trades are reconciled in an automated fashion. Just, give us a little bit of an impression of how it went. Was it spreadsheets? Was it Fortran? Was it, pencil charts and back of the envelope calculations? How did it work?
And I think that we'll find that if you talk to all trend followers, the day-to-day process is very much the same. And if you sort of say that most trend followers lead boring lives. So at the end of the day, what you do is you get only your prices in from the day. You're going to sort of run your model before the Asian Open, so that you're going to be able to have your stop losses in all the cases. You're going to have your entry and exit for all the positions. Those are then passed on to traders. Okay, you might have the software that you use has been usually proprietary or customized, and then it is given out to traders. Is that it may have started in the early 90s with spreadsheets, but obviously it had been developed into customized software for being able to execute orders for size. And then you watch the markets and see, okay, what gets triggered, how's the execution going? Did you ensure that the execution was efficient? And then you track performance during the day, and then there's a recap at the end of the day, and you start all over again. That would be the process for the actual trading. And then for myself or others, is that we're always looking at, well, is there a new model that we should look at? Is there a new way to optimize the portfolio? Should we be applying this to new markets? And we'll sort of say, especially at John Henry, is that John very much did not like to change or want to change models. So that you'd sort of say, once you stick with a model, you're not going to change, because if you sort of switch from model to model constantly based on the environment, is that you're actually going to get worse performance. So while we engaged in research to say, let's look at additional markets, let's look at how we sort of improve execution, there wasn't a focus to sort of say, well, let's sort of see what model will do well today versus what we've looked at in the past, and then try to sort of say, let's optimize the right model for current situation. That was not going on.
Yeah, no, just staying with John Henry for a little while longer. It's such an interesting story, and since the firm doesn't exist anymore, we're not stepping on anyone's toes by digging a little deeper. I am actually interested in your view on this, Mark, and that is, since you've been around for a long time, certainly I remember back in the 90s, there were, a number of firms that you kind of really were the symbol, or how should I say, describe sort of our industry, and John Henry was certainly one of them, and the biggest for a period of time. So I'm curious in what changed and why at the end of the day the firm stopped. So in that sense, you could say, was it John losing that focus? And once he's lost the focus, the business lost the focus? Was it the fact that, and I could be wrong here, so please correct me, but I have a feeling that the type of clients John Henry was catering to were the wirehouses, had, expensive commission rates and what have you. And once their business model died, where else do you go if you're kind of positioned in that? You don't necessarily can just transition to do institutional business. I'm just curious because because when you look at the field today of quote unquote the leading CTAs, I would also love to know why you think those firms survive. What did they do right? How had they evolved correctly? Because a lot of them actually have been around for also, 30 plus years.
Well, I think that John redirected his focus. Clearly, he had other interests, which was had an impact. I think that also this is that the markets changed because the cost structure for trading changed. This is that a lot of the long-term trend followers from the 80s, not just John Henry, but everyone in the industry, is that they were very much driven by long-term trends because the cost of trading short was just so high. It was prohibitive. So that as the economics in the futures business changed, then it allowed other people to come in and try different strategies and different models. So you had more short-term traders, you could try other things. I think that and this is not just to John Henry. I think that a lot of the American CTAs were more iconoclastic in the senses is that they believed in a philosophy of long-term trend following, or they believed in a philosophy that you never change models, or you very seldom change models. And I think that there is the new group of successful traders who were more coming out of quants, who were, we'll say, physicists, mathematicians, data scientists. A lot of them were coming out of London. I sort of half joke that it's, I'll call it the London quant mafia. So which were not iconoclastic. They said, we're just going to try to look at the data and sort of pick whatever we think is going to work. And so and I think this is maybe uniquely European versus American is that they say, well, we're going to look at things what we're going to pick which works, and we're going to be more adaptable. And we'll probably sort of say that the European quants out of London were probably quicker on the bandwagon to diversify their programs as CTAs beyond trend following. So when we had the sort of fallow period post, there have been periods where trend following hasn't done well. This is that you're not going to make money in trend following. There are no trends. And I think that being less iconoclastic, being more practical, the London quant mafia we probably said, it's like, we're going to have to adopt it. We're going to change. And so we're going to be called CTAs. We may have started out as trend followers, but we're going to sort of adapt and change some of our behavior, add other styles, because we just need to make sure that we ensure we hold clients or add clients. The market also changed because I think that John Henry and a lot of the trend followers from the 80s and 90s were more high volatility. So you'd sort of say that anywhere from 15 to 25% would be the volatility that you would see for, or even sometimes higher for a lot of the early CTAs. Now we'd probably sort of say that if you said you were going to be a 15% vol CTA, people would sort of say, whoa, that seems to be an awful lot of risk. That being said, talking to pension funds now, I think that there's more of a willingness or more of acceptance to sort of say, I'm looking for more high octane, high volatility managers who can perform well. If I have for a pension fund that has a discount rate of 7%, this is it. If you come in and say, well, I'm a 5 vol CTA and I make about 5%, then you can sort of say, well, you might be a great diversifier, but I still am 2% under my discount rate. How am I going to close my gap? So I think there's more of an idea that, well, I don't want a 5% CTA. I want someone who's a double-digit volatility. And when you think about it, is that for the same dollar committed, if you get someone who's going to run at a 10 to 15% vol or higher, you're getting more bang for your buck with the high volatility manager. If you're going to be paying money for a dollar invested, you're looking for, say, I want more exposure for that dollar invested.
Yeah, completely agree. Fascinating. Thanks for sharing.
I agree with that. I mean, I'm definitely a fan of higher volatility CTA exposure. I mean, there's an upper limit. If you're trading at 50 vol, then your blow up risk is far too high, right? But in terms of exposure per unit of volatility or exposure per unit of fee, whatever, it's a more efficient way to invest in CTAs if you say you go for the 15 to 25% or maybe even up to 30% volatility range, right? And then just invest less money to get the same bang for the buck. But I agree with you, for some strange reason, a lot of investors, I think, they're addicted to a smooth and soft return stream, and nothing is supposed to move more than, oh my God, 10% vol. 10% vol is the new maximum. Nobody is able to, stomach more than 10% vol. That is, they don't like it.
Right. Now, the interesting part is when you think about the regulation of CTAs in the United States versus mutual funds, let's say in the equity market. So there were always the view that, look, as a CTA regulated by the CFTC, is that I have to put in all my disclosure or drawdown numbers. So because you have to look at downside risk. And if you actually had all of U.S. equity mutual funds show their drawdown risk, a lot of people would be shocked. So that you're seeing 40, 50% plus drawdowns for equity funds. Some of them take years and years to actually get back to their high watermark. So if you put it as an apples to apples comparison, is that the drawdowns for CTAs are really not that bad when you look at by comparison what you see in some traditional markets. And then if you sort of say, even if you sort of look at how does it compare versus an index, their drawdowns can be pretty tough. And so the focus on drawdowns and that risk aspect has a lot to do with what was the regulatory environment in which the CTAs developed in.
Yeah. Do you want to dive into some of these specific topics, Moritz? We've got a long list, I think, of things we want to talk to Mark about.
Yes, we've got a long list. And by the way, thank you, Mark, for preparing that. I guess the one thing, let's just start with the one that's on the tip of me. It's diversification of trend following CTAs. How much is too much, or when is too much? How many markets should CTAs trade? Is there a limit to that number of markets where it becomes less efficient, so that the floor is yours? We'd like to hear you out. We, like Niels and our friends, we've debated that topic, I think, on numerous occasions in the past couple of weeks, and it stuck with us. So we'd like to hear your opinion on that.
Right. Well, let's start with the basic concept of diversification. Like any good that you buy, there's a marginal utility. Is that after you have more and more of some good, the marginal utility you receive from it is going to decline, and that also applies to diversification. So we're not saying that people shouldn't be diversified, but I think that you have to think through what are the implications of adding more diversification, especially if you're an active trading program. So some markets are better trend following than others. Some markets are very correlated with another. So if you sort of say, I want to add more markets, but it's within the same sector, let's say, for example, global bonds, this is where the correlation could be very high. The marginal impact of adding another market is going to be very low. So they're all going to be sort of fairly correlated. Now, so where you're going to get the most bang for your buck from diversification is obviously going to be from commodities. But commodities can also have situations where there may not be, you may have to wait a long time for certain trends to develop. And I think that what you find out is that as you get more and more diversification, you actually sort of will reduce the weight in some of the exposures that investors ultimately want. And when you think about it, is that they're always looking at how to sort of protect my core portfolio of stocks and bonds. As you add, and what happens is that the trends actually occur when correlations go to 1. So in that situation is that you sort of say that if you're very diversified, you don't get the benefit of the correlation going to 1. And you actually can have a situation that you don't perform as well as you would like at the critical periods when investors want it most. So I think that adding more markets is good, but there is going to come a point where you're going to actually have less value added from each market that's added. And now what you have seen is that some of the largest CTAs are probably under diversified. So the ones that are trading $1 million plus is that they're still going to be focused in on mostly equities. They're going to be focused on bonds, and they're going to have very little commodity exposure or a number of other markets, which they just can't trade. So what you'll find out that the smaller CTAs, it could actually be more diversified and get more value added than large ones who actually are forced into only trading global bonds and stocks because that's the only thing that's liquid enough for them to handle the money that they have. So there is a trade-off, and you could sort of say that there is a optimal size for CTA because as you get larger and larger, you can't trade all the markets and get the diversification you want.
I think you make a number of great points, Mark, and I want to stay with this a little bit because it has been really a topic that, as Moritz says, we've discussed many times. I come from the camp where I'm a believer in diversification, no doubt, but I actually think that there is a kind of a limit, and it's smaller than a lot of people think in terms of where, as you say, you continue to get a lot of benefit. I think Jerry and Moritz comes more from the camp that, yeah, as long as it's not perfectly correlated, you need to keep adding. Right. And I'm not quite there, to be honest. And I referenced it a little bit to a couple of things that one thing you said, but another thing is that there's this great video on YouTube with Ray Dalio, and he talks about the holy grail of diversification, and he has this handwritten chart that he shows, and he keeps saying that, you know, if it's only 60 or 70% correlated, I mean, you can add 1,000 instruments, but it's not really going to lower your risk. You're lowering your risk really comes from finding uncorrelated return streams, so very low correlation. And that, of course, we all agree with it. That is tremendous when you can find those. So that's kind of one thing why I believe that even if it's 60 or 70% correlated, because as you say, and this is really important, and my argument kind of in a simple way has been, I also think that we as managers, if we want to deliver outsized returns, we shouldn't be afraid of having quote unquote conviction in our portfolio, because as you rightly say, when there are trends, the portfolio tends to get quite correlated.
Right.
So yeah, we can have all this wonderful diversification, but actually we should not be afraid of having a correlated portfolio or portfolio with conviction from time to time, because that's where we make our money. And I fear a little bit that the inflow of institutional money has rushed a lot of managers to one, lower volatility overall, but also this idea that we just keep diversifying, and we kind of we end up watering out our returns to some extent. Yeah, the volatility is low, but the returns are not very sexy. And I think from my conversations with Harold at TransTrend, I think that they went to like 300, 350 markets, realizing that
Right.
that's too much. I mean, we have to scale back on that. So I'm not against diversification at all, but I actually think once you get kind of past 70 market-ish in a diversified portfolio, you probably don't need much more than that, because it will include a healthy dose of commodities. And as you say, yeah, okay, if you get more than 1 billion or 2 billion under management, you probably will start to lose that diversification. Completely agree. So those are my this is kind of part of this conversation we've had, and Moritz, chime in with why you think differently, because I think it's an important topic, and I think a lot of people struggle with coming to conclusions on it.
Right. Well, one of the things that you have to think about this is that there are other forms of just markets for diversification. So the framework that I have used, and I've used it for a long, long time, and so for me, it's second nature. I used to look when I look at analyzing a trend follower, I look at three things. I call it STM. What's their style, timing, and markets? And what happens is that you can get a certain amount of diversification in markets. So, what's the breadth of opportunities that they're looking at across markets? You also have to look at the timing, because you get diversification from the type of model you use. If you're just a long-term trend follower, you're not really diversified. If you have long and short term, so different timing models, then you're adding timing diversification. And then there's style. There's different styles that can actually be applied to the same market that can also give you diversification. So what I call is maybe a two-phase, where you're always either long or short a market, or a three-phase where you're long, short, or neutral. So the real issue about diversification also that I think about is that it's tied up with the type of model you use. If, let's say, you say, I always hold positions, and then I add more and more markets, well, then by definition, the contribution to any one market to your return is going to be lower and lower. If, on the other hand, you say, I trade, or I want to trade 70, 100, 200 markets, but then I rank order all of the markets, and I then only choose, let's say, for my long positions, the ones that have the most intense trend, and I only sort of take the short positions on the ones that have the most intense downtrends, well, then you actually sort of reduce diversification, because what you then use is that you collapse it into a fewer number of positions. So the diversification of markets is also tied with how you then position and take positions. So these are not separate questions.
Yeah.
So I just want to come back to that just one more time, Mark, and maybe let me set it up as kind of like a challenge.
Okay.
I think my opinion is that if you're just adding markets, you have a number n of markets in a trend following CTA system, and you're just adding markets and you give them all the same risk weight, then I think this will end up increasing your risk. Why do I say that? I say it because if you do it that way, you'll end up with a lot of equities, and you'll end up with a couple of bonds, all of which and FX markets, all of which, especially the equities and the bonds, they have a lot of correlation, right? So if you just give them the same weight, that probably isn't a good idea. As you've just mentioned, there's much less correlation within the commodities, right? But if I spot markets that have a relatively high correlation, then why give them the same weight? Use the example of gas oil and heating oil and crude, right? Let's say the correlation of those markets is between 0.7 or 0.8. I'm making that number up, but it's somewhere up there. It's relatively high, right? I don't have to give them the same weight. I can trade them all with like 1/3 weight or 1/2 weight. See what I mean?
Right.
So that, I can still add them to the portfolio and take the benefit of the fact that they are not perfectly correlated. their correlation is not 1. It is less than 1, right? So I have more markets in my portfolio. I have a greater opportunity, therefore, to detect the trend because just the number n of markets in my portfolio is greater. Now, one could say that, oh, your correlation observation, the 0.7 or 0.8 that I have just mentioned, is off because we know correlations are dynamic, right? It's not a constant God-given thing that they're always 0.8. So essentially, when I do it that way, I'm long correlation. If correlations increase, then I get more bang from the buck if they all get in the same trend, because then I have a good position on. If the correlation decreases, then I should have had a larger position. I should have given those markets a larger weight because of the fact that they're low correlated. So doing it that way, I don't see why there should be a disadvantage of spreading your risk and spreading your opportunity set. And the opportunities they all have, and this is, Jerry has been preaching to us for a long time, and I agree, they all have the same expectation in terms of the P&L that we can make from those trades. So why not broaden the opportunity set as much as we can?
No, I think there's no question is that broadening the opportunity set is a good thing. And I think if I hear you correctly, but at the same time is that you change the weights based on its relative correlation.
Exactly. It's a correlation-dependent weight.
Absolutely. And so I think that we are in agreement is that if you can find something that's going to be uncorrelated and liquid that you could be able to trade, you probably should add it. If you find something that is very similar to other markets that you already trade, then you say the marginal contribution may be less. Okay. So, and what you see is that when people build their portfolios, sometimes what they'll do is they'll allocate and max out the amount of exposure that they'll have in global equities. They'll max out their exposure in bonds, and then they'll have a certain bucket for commodities, so that then they'd be able to sort of, I don't want to say risk parity, but they're going to look at sort of allocating risk according to sectors, not just markets. That's one way in which they could be able to ensure that they get the right amount of diversification or enough diversification. So there's no question, as you mentioned before, is that adding more stock indices may not be able to get you what you want if you want to add more diversification and unique trading opportunities.
I want to ask you something, Moritz, because I still think a little bit differently to what you say. I get the point that you say, okay, instead of having 1% risk in each, I'm just going to say I'm going to have 1%, I'm going to divide it by 3. Fine. But what are you really, where's your real benefit? Because you're also going to make a lot less money in each market. So now you have to get all 3 markets trending at the same time to have a meaningful impact.
Yeah, but much less risk than just doing it on one market, right? If you just choose one market, what if you're on the unlucky side of that market all the time and it doesn't work out? At least I have 3 or 4 or 5, right? And therefore a greater probability that at least some of those will work.
Yeah, but I just don't. I don't see it in the data as such that having so little risk in some of these markets just to be less risk. And this is, I guess, I mean, maybe the risk-adjusted returns are higher. I don't know. I haven't seen it. If we use TransTrend as an example, if we just use them as an example because they're public about it, they've been doing it for a long time. If you look at the numbers, they don't seem to confirm.
I guess the great thing about our industry is that there's not one way of doing it. Maybe, we each would like to think that the way we do it is the best way out there and everybody should just sway our way. But obviously that's not the case. Every trend following CTA is different and they all have different opinions, the wrong word, but a different mindset on how to approach these things, right? You do it a little bit different than I do it. That's fine. But, case in point with the energy markets, because we've just used them. 3 months ago or 2.5 months ago, all the energies were moving down, right? It's not just been crude oil. The May contract or whatever it was went negative. But when you look at the overall petroleum complex, gas oil, heating oil, RBOB, all of that type of stuff, it all went down. Nat gas went down even. So it didn't matter that I have a correlation-dependent weight and less risk weight, for instance, in crude, because they all came around. I essentially had the full position on.
But you also
there's
hear
no diversification then.
Exactly, but I'm just countering Niels's point, where it's saying like, yeah, but then you don't get the full benefit of the trend. Well, I got the full benefit on the short side on the energies because I had the appropriate size in each of those markets.
But Mark makes a really good point there. But that's without diversification, right? You needed everything to move together to get the same benefit. And I want to point it back to the stories that Jerry has told a few times. And that is, how he made a whole year's of performance in one of the energies, right? So sometimes you get this blast that sometimes, heating oil or whatever it is, nat gas or whatever it is, just goes ballistic. And this is where I think that methodology loses out, because then you get the diversification of having an actual opportunity of making a meaningful amount of money from just one market going berserk, so to speak.
You have that and the risk as well, because using my example again, and then we'll let Mark talk about that. I mean, it's fascinating because in my example, yes, I mean, I benefited from the fact that they were correlated during that point in time, and that essentially gave me the full energy position on, right? Now, if you say, in contrast to Moritz, I'm only going to trade crude, right? Because I know that heating oil and RBOB and gas oil, they're correlated markets, so let's just drop them. If for some reason, as we know, correlations are dynamic and they're not always 0.8. So for some strange reason, the thing is only about crude, right? And crude doesn't move, but heating oil goes down and RBOB goes down and gas oil goes down. At least I still have three markets that work for me. Whereas you, because you bet on crude only, don't get the benefit at all. So it's not just about making the money. It's also about, spreading the opportunity set and the risk.
And that is, of course, true. But I know very few CTAs who would trade just crude, right? So the point I'm trying to make is that, and I'd love to hear your point, Mark, on this. From a portfolio construction point of view of a CTA, right? We know that energy, they're liquid. So they have to have a meaningful part. They have to be a meaningful part of your portfolio anyways, because there aren't that many super liquid markets once you get to the commodities, right? So you need to give a decent weight to energies, you need to give a decent weight to metals and so on and so forth. So I just think personally that it would be unlikely anyways. And I accept that, if all the energy markets turn at the same time, just like the bonds turn at the same time, just like equities turn at the same time, or the dollar, you're going to lose some money. Of course you will, because it's correlated. I just don't think we should shy away from that and say, that's the price we pay. But we also have to have a decent chance of making real performance, outstanding performance. And if we diversify too much, we're going to lose that. But as you can see, Mark, it's a topic that we love to debate. We don't agree, but we love to debate it.
These are some of the paradoxes of trend following. So most trend followers would say, if you ask them, they're non-predictive. They say, I can't tell you what markets are going to make money. And what they do find in reality is that there's an 80-20 rule. Is that most of your money is made by just a few markets. And if you look at the end of the year, you didn't know which ones that you couldn't have predicted which ones you're going to make markets. I can't predict what trend will next. I know that most of my money will come from just a few trades. So I want to trade as broad a basket as possible. So that would be on one hand the argument. And then you sort of say, so in the energy complex, I don't know if it's going to come from heating oil. I don't know if it's going to come from crude or natural gas. I got to trade everything because I can't predict which one will do well. On the other hand, is that the big argument comes in is that you make your real big money, not where you make, if for any given year you might make a lot of your money for a few markets, is that you make your big money as a trend follower when everything starts to correlate and you got multiple positions that are all trending in the same direction. So you sort of say, like, if I want to have a very, very good year, an impressive year, I need to have everything moving together. So I don't want the diversification. I want all the energy sector moving in the same direction. I want global equities moving in the same direction. I want bonds moving in the same direction. Is that if I do that and I even if I trade all of those markets, I'm going to do very well because the correlations are going to one. And if there's all trending, I'm going to make money in all of those markets.
Yeah, I guess maybe the reason why I defend my position a little bit is that I come from this very strong belief that trend following is based on the fact that we can't predict. And this is why I think you have to treat all markets equal. and not make a prediction saying, well, these three are correlated most of the time, so I'm going to reduce the risk to these guys, right? For me, I'm just going to treat it equally because I don't know if it's going to be heating oil or crude oil or nat gas, but I have to control the sector risk. I do know that we have to make decisions on that. I agree. But anyways, we could probably go on another hour. So what do you want to talk about, Moritz?
I'd like to ask the two of you a
Okay.
question. So when you think about this, is that you could trade a lot of markets and you could have, I have positions in everything. Or, so we'll sort of say the classic academic momentum strategy is that I rank order everything. And so even though I might look at a broad universe, I condense that down to a rank order of my longs and shorts to fewer positions. How do you two view that issue? Because I think that ultimately a classic momentum academic would say, sure, we could I could look at 1,000 equities because I'm just going to rank order and I'm going to buy the top decile and sell the lowest decile. So it doesn't matter because I'm only picking the top anyway. So how do you two reconcile that with diversification?
I don't do the rank ordering.
Okay.
I do this, what I've just called the correlation dependent risk way. And I don't want to see my portfolio have one position in the bubble and another position in the shots and just go full on the two of them, and then the 10-year and then all the other bonds, because I should have done that. With the bonds, with the benefit of hindsight, yes, just, put much more weight into the bonds because they've been performing so well for trend following CTAs, right? But I know that on a given day, when the shots moves up, the bubble is likely to be up. The number of days that you can count where they're moving in opposite directions is very little. So I know there is a very consistent correlation cluster there. It's a persistent correlation. It's unlikely to go away. And I would like to take that into account and not just, give the bubble the same footprint as the shots and the same footprint as the 10-year. This is not how it works for me. And I don't want to rank order them. If they hit their breakouts or whatever, signals people use, I then take the position. There's no ordering and saying like, hey, I'm only going to go long if there's a 50-day breakout, a 100-day breakout, a 150-day breakout. Oh, now I'm happy. Now I'm going long. No. I go long with every signal.
Right. And I think that defines a lot of CTAs versus, we'll sort of say, the academic risk premium crowd, which are all relativists. And I think that most trend followers are sort of absolutists. I'm looking for trends. It doesn't matter. I'm not going to rank order them. If there's a trend, I want to take a position and I want to look at it in those terms, as opposed to, we'll call it a trend momentum relativist. And I think that that's the success of many CTAs is because they're, we'll say, more absolutists.
So on our side, we want to treat as a starting point everything equal. So we allow all markets, if they were at full risk, to have the same contribution or the same risk allocation in the portfolio. But we diversify across a few different levels. One, I would say we're one of the firms, and I think this has been a core belief of Don always, is that we want to have a meaningful allocation to commodities. So we have 40% of the markets are commodities. Sure, that means we're not going to be the next Winton with 20 billion under management, for sure. So we accept that our capacity is going to be smaller, but the fact that we don't charge a management fee also means that we want to deliver absolute returns to our clients. We continue to do so. So that's one thing. We diversify, as you say, across style. So we do have a binary type old classical trend following model, which Bill Dunn developed back in the 70s when he first got started. And of course it's evolved, but that's one kind of trend following. And as you say, you're kind of either long or you're short. But then we have a different trend following model that can be neutral for a lot of the time. It's much more sensitive, much more fast reacting from time to time. So we can diversify on that as well. So you could say the confidence level we build up in terms of positions is and then of course timeframes. We diversify in many different timeframes. So I guess we end up building up the confidence in each of these markets through all of these different decisions. And that's why we're not afraid of ending up having both a decent side exposure to the shots and the bubble. If that is what all the models are dictating, we'll do it. But we also have many ways of of getting out because they won't obviously exit at the same time and so on and so forth. But I agree with Moritz in the sense that the beauty of what we do as an industry is we don't do it the same way, everyone. And that's great. And this is also why I said it's interesting that both Moritz and on our side this year, we seem to be behind the field if we look at the peers. So clearly we're doing something different, even though we between us ourselves do something different. We're also doing something different to a lot of the other firms out there.
Right. And some of that, I think, looking at CTAs for this year, is that those who have been more diversified may have underperformed relative to those who have been more focused. That may not continue for the rest of the year or for next year, but those that have been very focused probably have been able to exploit the biggest trends this year. Those who have been more diversified, especially in commodities, where you haven't had, outside the energy section, you haven't had as big of moves in some cases, or they're now coming now, like in the case of silver. I think that you're going to see a different performance track record. You're going to see more dispersion in returns, which I think is the one thing that we've seen, especially in 2020. There's been more dispersion in returns across CTAs, and what that tells us is that they're not doing all the same thing. Their exposure to markets, to styles are very different. And when volatility goes up, you're going to see more dispersion in returns across trend followers.
And that was one of the topics we also had for today, so we can kind of dive into that just with maybe a follow-up question. That is, what do you think is the main driver of dispersion? Is it the markets that managers trade, or the style they trade, or timeframes? What do you think, where does dispersion really stem from?
It's a little bit of both. So one, I think there's dispersion from market sectors, so that can be a big driver for performance. And then I think second is that the style. So I think that you can be able to actually analyze the dispersion of returns in sectors a little bit easier to try to get a handle about what's going to be the impact on volatility on a manager, what their performance might look like in the future. Style is much harder to sort of quantify in terms of, okay, if I'm a long-term trend follower, how will I differ from someone who has multiple time frames? That's harder to distinguish between managers. But as volatility goes up, what you're going to see that all of the small decisions that trend followers make, all of the choices that they make actually then become amplified. And that's when you start seeing it through the dispersion in performance.
Moritz, where do you want to go next?
Many ways. It's amazing. We are beyond the 1 hour mark, and we haven't even touched on vol targeting. I think we have to get Mark back to get through his list of questions. There's another 8 ones left. I mean, we'll probably do 3 hours, but maybe just focusing on. I mean, we've had some technical topics here, but what I would like to have a word about is, or chat about, is what you say is the narrative of selling a strategy, which I think is important. What can be done better? So what can CTAs do better to convey their message and sell their strategy, and what should they focus on?
Right. This is an ongoing piece of research that I have, because as you do more and more due diligence on managers, you look at managers, what you find out is that the narrative that they use, either in DDQs, in their pitch books, have a huge influence on whether money is going to be directed to them or not. So narrative matters. Even scientists will use narrative. They'll use metaphors to describe what they do to try to make it more accessible to their readers and to the people that they're trying to teach, or the people that they're trying to convince in their arguments. So narrative and storytelling is very important. And I think that that's something that CTAs, quant managers in general, have not spent a lot of time on. Because if you say, if I'm a trend follower, you say, yeah, I'm a trend follower. Is that I'm non-predictive. I look for trends. When I make trends, I make money. If there are no trends, I don't make money. I'm sort of saying this somewhat tongue-in-cheek, but that narrative is different than if you have someone who's a discretionary global macro trader, and you'll say, well, here's what I think central banks are going to do, and here's what how I'm delving into the minutia of fundamental information. And you can sort of see that the listener is sitting at the edge of his seat, wanting to hear exactly what the narrative that they're hearing from this discretionary manager. And a trend follower, you go in there and you tell your story. You say like, well, here's what I do: is that it's a model. I trade the trends. That's it. I'm not trying to figure out what the Jay Powell is trying to do. I just follow trends. So I think that as an industry, when you think about it, is that CTAs and trend following is still one of the most powerful hedge fund alternatives available, and yet the narrative has not been strong on why this is value added. We've been sort of had the narrative of sort of the last decade might be crisis alpha, which I think that everyone has got on that bandwagon for a while. They use that as the narrative. But I think that if you go to a lot of pension funds, if you use the word crisis alpha, is that they will have a frown on their face. They do not like that concept. And I think that it doesn't really tell exactly what a trend follower is doing. It doesn't show what the value added. So I think that we need to have, as an industry for trend followers, a better narrative story. And I think that that's something that we need to work on.
Yeah, I mean, have you worked on it so far? I mean, do you have any? Can you share any ideas of where you think we should be going with that? Because I think, as you rightly say, I think it's been a big part of the reason why perhaps this strategy, despite all the evidence proving that it's probably, as you say, the most powerful of the alternative investment strategies, it doesn't show up in the numbers in terms of size, especially
Right.
if you remove Bridgewater from the AUM, which I think actually it should be, because I don't see them as a pure CTA. So if you remove them, we're down to like a couple of $100 billion in size, which is small.
Right. There's a couple themes that I sort of like to focus on. One is that, I've written about in the past, is what I call the difference between convergent and divergent styles. This is that trend following is divergent in the sense is that you make money when markets move away from equilibrium. When there's dislocations in markets, is that which are often unpredictable, unexpected, that's when trend followers are going to make money, because they're trying to exploit that. They're not trying to look for what is fair value. They're just looking at, said, if there's no dislocations, we're not going to make money. If there are dislocations, we will make money. So that's one theme that I think that needs to be pushed more, and I think that that resonates well with investors. The second is, instead of talking about crisis alpha, is talking about is that what is the value of trend following, because we do well under periods of financial stress. So I've looked at some numbers of when you look at stress numbers, okay, or risk aversion numbers. That's when trend followers do well, because when you think about it, when traders, investors are under stress, they're probably going to not make decisions as quickly as before. They're going to then start to lead to more trends, which can be exploited by the trend follower. So in some senses, is that it's not so much a crisis, because then when you always have crisis alpha, you say like, well, what do you do when there's no crisis? You're left with this hollow idea of, why should I hold this investment? Because then I'm going to say I'm waiting for the next crisis, and you can't tell me when it's going to occur. So what do I do? And what does it mean that you have an alpha? But if you sort of said, look, if there are financial stress, there's going to be dislocations. When there's stress, then people are going to start to change their behavior, and they're going to be more cautious, which means the different flows and behavior is going to lead to trends. That's something that we try to exploit. And the final, which is, I've talked about this, is that this concept of VUCA, and I'm actually trying to write a book on this, is that it's the Army War College came up with this concept, that when an Army commander is in the battlefield, he actually faces a environment which they give the acronym of VUCA. It's volatility, uncertainty, complexity, and ambiguity. And you say that if you want to be a good trained Army officer, you have to determine, how do you deal with VUCA? And you think about it is that, well, what do trend followers do in a VUCA world? You say like, well, we follow rules. We're going to start to follow trends, okay, because we're going to say that When volatility goes up, there's more dispersion in prices. So following a trend or be a divergent trader is good. When there's a high level of uncertainty, you don't know what to do. So in that sense, is that actually following the checklist or following what the price behavior is probably a good thing to do. When there's a high level of complexity, that what you want to try to do is you could be stymied by this complexity. So do you want to try to simplify your rules, simplify your behavior? And again, that sort of leads to trend following. And ambiguity, when you sort of say that when you run a model, you could say there's the independent variables that are uncertain. So if I sort of say there's a relationship between bonds and inflation, and there's some coefficient on this relationship, you say that, well, there's uncertainty about what inflation will be, but we don't really know for sure what's going to be that coefficient or what that relationship between inflation and bonds would be. That's ambiguity to some degree. You could go into more probabilistic thinking about the Ellsberg paradox, but I think that what we want to try to think about just the ambiguity is that when complex models don't work well, when there's a lot of stress and there's a lot of uncertainty. And so I think that then it goes back to using more simple rules. And I think that thinking in those terms can get people to wrap around what the value added of a rules-based, price-based trend system would look like. So these are some of the things that I think about in the narrative. I think that each manager just need to work on his own narrative, but at the same time, I think that it's something that they probably should spend more time. So everyone sort of says, okay, I've got a great model. I've done all my back testing. I'm a smart guy. People will give me money. And that's not the case, is that you have to work at being able to convey how you're smart in a way that will elicit some emotion that people say, I'm moved enough to actually give you money. And even in terms of how you sort of describe your model is important. And the analogy I give is, I call it the cookbook analogy. It's like, so you go to a bookstore and you go down to the aisle where it says cookbooks. And you see all these great chefs will have cookbooks, and what they'll do is you pick up one of their cookbooks and they'll give you all of their secrets of how they prepare their meal. They'll tell you in the cookbook, here are all the ingredients. Here's the exact measurements. I'll show you pictures of what I do. I'll go through step by step on exactly what I'm going to do to get this great meal or this great souffle. And then at the end of the day, you read this, you say, like, it's all here. I could be a master chef. I just have to follow this cookbook. You go home, you try it out. What happens? It fails. Then you realize that in reality is that, like, wow, what this chef is doing is so complex. Although it seems simple after I read the cookbook, I should just hire him. I'm going to go to his restaurant and I'll pay a premium for him to prepare the meal because I know exactly how complex it is to do this myself. And in some senses, is that I think that what that tells me is that trend followers should be more open and transparent about what they do, because you can sort of say that I can tell you what I'm going to do, and I can say, well, I've back tested this and I've done this and I've tested this model. This is that you can't do that yourself. So if you try to replicate it, it's going to be very hard. And I could sort of say the real value of research is not what you find, it's what you find that doesn't work that you throw out. And so I think that if you tell people and provide more transparency, I think that they receive more confidence in you as a manager. It advances a narrative. And at the same time, what you find out is it's going to be very hard for them to actually replicate what you do. So there is something called practical knowledge. And practical knowledge, when you think about it, is that for each one of Niels, you, for Moritz, if you get Jerry, if we sort of said, show me your model, this is that I don't think that they could probably replicate if you sort of say, here's all the rules, not the code, but you say, here's your rules. They couldn't replicate what you do because there's a level of practical knowledge that you have that can't be bottled. And that's what people pay for.
Which is the experience, right?
Yeah.
In a way.
It's the experience.
I mean, you have zero practical knowledge if you don't have experience.
So there's an old Greek term for this. It's called metis, and the old Greek term is that it's often referred to as cunning intelligence. And when you think about it, is that you say John Henry, Dunn, all of the great managers had this metis or practical knowledge or cunning intelligence on how to implement, trend following in a way that made them successful. And that's what investors should pay for. And now what the job of the manager is to tell a narrative on why that they consider, say, their metis is something that's value that someone should be willing to pay for.
And I love that, Mark. I mean, I love the whole thing you said about narrative. I completely agree with it. I actually also think it explains why a lot of these quote unquote trend replicator that the banks suddenly were experts in developing and trend following is so easy to do. Well, if you look at the numbers, you look at the performance, I mean, none of them have done as well as you say, the people who've been around for a long time and have that cunning intelligence about how it really works. I wanted also to get in a question a little bit off topic of trend following per se, but just a little bit relating to your work, because clearly you spend a lot of time with your blog, which is fantastic. Everybody should read that. But content is not necessarily easy to produce. We do it here every week and sometimes a little bit extra, and it takes a lot of work, frankly. And I was just curious, I mean, how do you come up with all the ideas for all the blogs? I mean, you write a blog almost every day. I mean, what's your source of inspiration?
It's just I read a lot. People ask me questions. I try to be curious myself. And if you read my blog, sometimes it'll talk about futures and trend following. Sometimes it talks about ARP. Sometimes it goes macro. So these are just the things that sort of interest me or I'm curious about. And what I'm or I like to say that if I'm curious about it, I'm doing a little bit of study. And I started out as just like a notebook for myself. And this was back over 20 years ago. I just have notebooks like, okay, if I'm reading a research piece, okay, what did I get out of this, or what am I thinking, or what more questions I have? And then I started saying is that, well, if I write my notebooks of ideas, then this is going to help me think better. And then I said, well, why don't I just then put it into a blog form? So I would actually sort of say, like, I probably have more ideas than I have time to write about it. It's almost as actually trying to prioritize what's more interesting. And I will sort of say some things I find very interesting, because I could see the number of people that click and read. They say like, oh, this is really good writing. I love what I wrote about. This is a great topic. And I find out nobody reads. Right. And then something else I sort of say, it's almost like trend following, non-predict. I can't predict what people are going to like.
Yeah.
And other topics, I could sort of say that I'd say like, okay, this is a piece of research I have. I'll give a quick little summary. I'll post it. And all of a sudden is bam, there'll be a couple hundred hits. So sometimes you just don't know. So it's a work of what I find interesting at a given point in time.
We talked a lot about focus already in this episode. We used the word a lot. I'm just curious, again, back to your process of producing all this wonderful content. I mean, do you actually have a specific time of day where you say, I'm going to sit down from 9 to 11 in the morning and write, this is my focus time? Or is it much more of I'll find an hour here and there to just put out a blog?
It probably is in the evening. I'll sort of do most of the work and I'll do the outlining because that's what I'm doing, my extra reading and research. And then I might write something. I'll put it away. I'll read it first thing in the morning and then hit the send button. So I just sort of say like, did I forget something? So it's an evening sort of an evening ritual. I have a stack of things that I'm looking at, and it says the advantage is as your kids get older and you become an empty nester, then you find out is that you have time for other things.
Well, just like the good cooking example you gave, usually it tastes better if you let it marinate overnight anyway. So it seems like you're doing the same with your content.
Yes,
Moritz, where do you want to go next? I think we'll keep Mark on a little bit longer today because there's so much good stuff to talk about.
Yeah, much good stuff. Maybe one more, and being respectful of the time. But there's such a nice long list that you've provided, Mark. We should definitely get you back on. But The second point that you make here is convexity of trend followers and the new big buzz.
Yeah.
So convexity we've heard about. Why is this the new big buzz, or is this the new big buzz, or is there something else, the new big buzz that we don't know about, but you do?
Well, the talking with my partner Tim Tanko, and we talked to a lot of pension funds, a lot of institutional investors, and we're just sort of seeing that, especially in 2020, more people are using the term convexity than we've had in years. So, in some senses, is that, and this is, I think, an outgrowth of what happened in 2020. This is what you sort of see that you say, what are everyone's talk about? Oh, I got to have tail risk protection. I got to have downside hedging. And then if you did that, you put in all your tail risk hedge or whatever it is that in March, and you paid for that, and what you sort of find out is that, and you sort of locked in some of that hedge, then you weren't able to capture any of the upside in April if you didn't lift those hedges or get out or change your positioning. And what you really find out is that this is almost the investment that people want to have is to say, I want to have something that is going to have positive upside beta and negative downside beta. So I want to have beta that's going to be sort of, if the market is going up, I got to be able to capture some of that market upside. If the market's going down, I need protection. And I think that they believe that some people talked about downside protection over the last decade, but then they didn't give it, and they didn't receive any of the upside. It didn't sort of participate in the big, global equity rally for the last 10 years. So they're saying, I said, no, I don't want to have something that's just going to hedge and offer diversification benefits. I need to have something that actually is going to be able to participate in the upside, but then also give me downside protection. Of course, this is the holy grail. But when you think about going back to our talk about crisis alpha, they said, well, I don't want crisis alpha if it's something that doesn't make me any money in normal times and then makes me money and there's a crisis. I don't really like that investment. I want something that's more convex. I need to have that convexity. And when you go back to narrative, you'd say the academics would say trend follower, they're long a straddle. This is it. Now tell me, if you go to an institutional investor or any investor and you say they say, well, what's your style? You say, well, sir, I'm long a straddle. so is that going to stir their hearts? Are they going to be moved to invest with you if you say, well, I'm just a portfolio of long straddles? So now, if you start saying convexity, then I'm going to give you upside beta, okay, when the market is going higher. I'm going to try to give you downside protection if the market reverse. Then you can say, from a narrative perspective, that actually sort of seems to make more sense. And then if you sort of say, well, why does that occur? It's because there's market have divergences. Why do market diverge? Because they're going under stress. And what happens when there's stress? Well, there's VUCA, and people start to change their behavior. And we're sort of following rules so that then in this uncertain world, we could be able to make money. Then you're talking about a story that actually is a narrative that makes this very impressionable on investors, and actually said, this is different than what I'm hearing from a lot of other hedge fund managers. This is something that actually is unique in my portfolio, and this is something that I want to have.
Yeah, no, I think that makes a lot of sense. My last question is just something I think also you wrote about recently, and I know that our friends at AQR wrote an article about it recently, and that is this whole thing about, so what is the best protection you can get? Is it from buying put options? Is it from hedge funds? Or is it, in fact, from trend followers? I'd love to hear sort of what your findings were when looking at this topic, which I believe you did that as well. You looked at this topic. Yeah.
And this has been an ongoing issue for probably decades. That people have always looked at the sort of tail protection. Should I use puts or should I use trend following? And so the argument has been, in some senses, that, well, puts, you can be able to know exactly what you're getting. If I buy 20% out of the money puts, that I could get this kind of downside protection. This is what I have. Now, the problem comes in is that if you did this put strategy on an ongoing basis, is that the returns are horrible. You really are buying insurance. So you're paying out money for protection and you're not getting any positive return. And you still have a problem is that even though you sort of buy a 20% out of the money put, is that you still have to roll that. If the market doesn't go down 20%, then you're going to have certain payoffs. If it's a slow grind lower at just a 2% a month, you're never going to be able to hit that strike on the down market. And so what happens is you're not getting the same protection. On the other hand, is that when you think about trend following, is that it's not an insurance policy. Is that you could potentially make money for trend following because there could be you could make money on a trends that go higher, and you could also make money on the trends lower. There is a correlation that you're going to have against your traditional investments, but at the same time, is that there is both upside and downside. In some senses, that the put option does not give you any convexity. Trend following does, because you have the opportunity to make money if trends are going higher. And so I think that there's a theoretical reason for why you should prefer trend following. And I think that their empirical work, which is an update of, I think, work that we've seen in the past, it shows that when you compare it against a rolling put strategy, it does significantly better than any put strategy. So on both a theoretical reason and for an empirical testing, is that if you're worried about your downside risk or you're looking for some diversification, but you don't know when that next big down move is going to occur, is that trend following will empirically over the time period they tested is a better alternative than puts.
Yeah, no, I completely agree, and of course that adds to the evidence that we have as an industry, and hopefully we'll, with some better narrative now that we have the VUCA and the cookbook and all of that good stuff, we'll make more progress than we have made in the last 30 years. That's going to be great. Let me just throw in a few things we normally do as well, and that is to update you as to how this wonderful industry is doing this year and this month. The Beta 50 index up 2.25%, but still down 64 basis points for the year. SocGen CTA index up almost 2% in July, but still down just less than 1% this year. The trend index also up 2.33% in July, up 1.5% for the year. And the short-term traders index is pretty much flat, up 13 basis points, but up 3.11% for the year. And the bridge alternatives up 2.2% in July and up about 0.75% so far this year. And this is all as of Thursday. I think Friday was probably a little bit of a down day for most trend followers. Any last questions, Moritz, thoughts you want to throw in?
No, thank you, Mark. I really enjoyed that. Very appreciative of you coming on. It's been a great conversation, I think.
Niels, Moritz, thanks for inviting me. It's been a pleasure. I'm really surprised. I'm looking at the recording time. We're just at 90 minutes. This went by very quickly, so I really enjoyed it.
Yeah, no, thanks so much for spending your Saturday morning with us. We really do appreciate it, as I'm sure all our listeners do. And you're absolutely as insightful to listen to as you are on your blog posts. So this has been a real treat. And of course, make sure you follow Mark on Twitter and on his blog post as well. And I would just end up by saying, Mark, Moritz, and me, thank you from Mark, Moritz, and me, I should say. Thanks so much for listening. And we look forward to being back with you next week. And in the meantime, be well.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.